I think it should, and I think we're actually going to see more follow-through of the sell-off in the coming days. This was a materially, I think, problematic report from the Fed's perspective. And this is on top of the payroll report from Friday. If you actually look at the internals of this report today, those aspects that were more transitory, like, for example, auto sales, or sorry, auto prices flat month over month. The real problems were much broader and were sort of the stickier parts of the CPI. And so this is an indication that the Fed is going to be much more aggressive in their policy. I think if you look back a week, the market was thinking 25 bips based on what the Fed governors were saying. But this is now all changed with the employment report on Friday and today's CPI report. They're going to have to be much more aggressive. And what this means is not just the Fed hikes, but this is actually going to pull forward the balance sheet reduction and could create a situation where they make sales. And this is showing up in the rates market. You look at real yields today. They're making a new high. They're at a year-and-a-half high. They're over 100 bips off the bottom. And then two-year yields, up to 1.57%. So the rates market is really pricing this in very quickly. And equity multiples are not reflecting, in my view, this policy.
Well, that's the key question here to me, Eric, is everything you've said, the bond market's nodding right along with you and says, we got it. That's what we're pricing in. Yep. That's completely built into the current stance in fixed income. Whereas the equity market, looking at the same information, now you've seen, obviously, that correction. Most stocks were down much more than the S&P was. And yet it seems as if we have a decent earnings flow, pretty good corporate and consumer balance sheets, and people are trying to look on the bright side of what pricing power means for corporate America. So can stocks withstand even that scenario that you lay out?
So I think there's a couple things that have helped equities. Corporate earnings, as you mentioned, have been fantastic, and estimates have risen 25% over the last year and a half. People were thinking it a year ago, and so all that has been very positive. But if you look at where earnings are now, operating margins right now are 15.5%. The high over the last 40 years was 14%. They're getting a bump from a lot of the pull forward during COVID and pricing power. And so we don't think that is, sustainable. Ultimately, this market has been held up by the flows, the inflows from the individual investor. In January, they were the buyer. They put over $100 billion into the equity market. So the real question is going to be going forward, does the individual investor get shaken? And does the individual investor look at some of these yields and start to say, these are getting more interesting. There's a lot of risk in the equity markets. I'm going to start moving money out of equity into bonds. And we haven't really seen that yet. But I think that as the market moves, slightly lower and people start to get shaken, and I think that is going to come to fruition.